Good morning, everybody. Rob Jastrzebski with RJ Homes and Remax Elite here. And today I'm starting a new segment where I'm going to be discussing with my partner here, Andre, some updates to the mortgage rules. Basically, we're going to be discussing this every time Bank of Canada has any updates, any changes to the mortgage rules, mortgage incentive programs, and go from there. So today I'm with
Andre Houle with DLC Maximum Mortgages.
And today we want to discuss the new incentive program that was just launched with Bank of Canada. It was September 2nd.
Correct.
So tell us a little bit about it. There's a lot of confusion out there, and I know I've had a lot of clients ask me about the program. So if you could kind of give us a good idea of what it's about, that'd be great.
No, we can look ahead into a little bit onto the program now. So it's correct. It launched here on September 2nd. We can't have a purchase date prior to November 1st. So great. So even if we're looking today, we still need to have to make sure that our possession's a couple of months from now. Okay, so that's the first part. The second part, what it really is on a regular mortgage, on a resale mortgage, you're looking at a 5% that the government will put in towards your mortgage. If it's a new build, they're going up to 10%. Okay, so if you put 5% down, because you still need to put the original 5% down of your own money.
Okay, so it's not like a zero.
It's not a zero down program.
Okay,
correct. So you still need to put the initial 5% with the standard down payment conditions, and then the government will put in the 5% on an existing home or 10% on new construction. So you end up looking at either a 10% or a 15% down payment if you only put in your initial 5.
Oh, so it brings your equity position up and your mortgage amount down.
So your payment drops, so it helps also on how much you can qualify for.
And what about CMHC fees, because you're putting down less than 20%?
Correct.
Right?
So CMHC fees aren't calculated based on your initial 5% down payment. It's calculated after the government puts in their portion. So you actually save that as well, because CMHC fees drop every time you go in 5% increments.
Okay, so what is it, if you don't mind, just kind of review what are the CMHC fees if you're only putting down 5% as opposed to 10
well, for instance,
15?
Right, so right now with the 5% down would be a 4% CMHC fee that gets calculated and added into your mortgage. Once you get to the 10% down, then it looks to 3.2%. So you save that 0.8% by utilizing the program.
Oh,
okay. So there is some benefits there. The next part is also you might be able to qualify for a little bit more because of the fact that now your mortgage payment has dropped. Okay, so your qualification might actually go up.
Right.
This program does have some rules and limitations on you can only have a maximum household income of $120,000 a year. The other stipulation is your mortgage can't be more than 4 times the your income level.
Okay, so if you're earning $100,000, then
the maximum is
$400,000 purchase price. Okay. Now, who is this incentive program geared towards? Who qualifies for this incentive program?
Right. So this incentive program is just for new home buyers.
First time
home buyers.
Okay. First time home buyers.
Right. So you can't be a existing. There's some nuances in the program where the old home buyers program for RSP withdrawals, if you were married to somebody living in a home with somebody that's already owned a home, then you wouldn't qualify for the program. That's changing a little bit now, especially on the separation and divorce. They're allowing you to become new home. If you've never owned the home, they've allowed you to have that capability to use the program.
So you mean that if a couple just joined and one of them owned a home and the other didn't,
the other one is still qualified to get this program.
Okay, well there you go. Another good thing to know.
Yeah, so that does help that. They also have now getting into some of the other parts of the program, you have to repay it back. So it's not something that you get.
So it's not a gift.
It's not a gift.
Not a gift. Imagine that. Bank of Canada would not give us a gift.
Right. So what happens is it is due on sale. You can pay it whenever you'd like to and due on sale or at the end of the 25 years because you're going to have a maximum 25-year amortization.
First, okay.
So whatever comes first. Now, The sale part is also if you decided to refinance the home, if you decided to port the mortgage to a new home. Okay.
Good to know. So at that point, you would have to pay it back. There you go.
And then you would not qualify for it again because you've been a homeowner.
So you can pay it back earlier than selling your home or before the 25-year mark.
Right.
But
voluntarily,
and then maybe let's discuss how does that look, because I know that there is some stipulations with the repayment as well.
There is. So when you're looking at the repayment part, it's based on the current value of the home at that time. So if you were, for instance, to buy an existing home and you got the 5% new home incentive, new home buyer's incentive, 10 years go by, you've completely redone the kitchen, you've completely done the basement renovation. So that home that you bought for $300,000, market's gone up. Now we're at $400,000. Okay. The government will also share in the increase of that value. So you would have got at 5% down on a $300,000 mortgage, you would have received $15,000 from the government.
Right.
With it going up to $400,000, you'd actually have to pay back $20,000 because you'd be 5% of the $400,000 that it's worth at that point.
So because the home has gone up by 5%.
Well, the home has gone up by whatever amount it is. The government, you still have to give 5% of that because it's a shared equity program.
Okay.
So they're giving you 5% equity, you've got 95% equity. At the end when you sell, they're still getting their 5%. Now it also works the other way. So if the market declines, your house is worth now, instead of 300, now it's worth, for easy math, let's use 200.
Sure.
Okay. Now you'd only have to pay back $10,000, 5% of the 200. Okay. So a smart, I don't want to say a smart investor or a first-time home buyer, because it's got the 25-year amortization, there's going to be ups and downs in the market.
Of course.
So if you have the cash available, when you're in a downturn, it might make sense to prepay this off. And now you've got, when it comes back up, you have now don't have to pay CMAC on the higher amount.
Right.
Okay, so that's the limitations on the program. There's a lot of ways to look at it, but then try to come up with that $15,000
in a down market.
In a down market is tough too. So that's kind of how that program works in that aspect of the repayment.
So the positive thing is you end up with having a lower mortgage amount, lower CMHC fees, so you can potentially qualify for more because your total debt service ratio is lower with your lower mortgage payments. However, on repayment, it depends whether your home equity or your home has actually gone up in value or it's gone down in value. The program works in such a way that whether if your home has gone up, let's say 5%, the total amount of the purchase price, the original purchase price, then you add the 5% on top of that. So you take your, say, $15,000 in our example,
right.
You have to add the 5% increase to that $15,000.
Right, well, you end up using the 5% of the sale price is probably the easiest way to explain it. Okay, so because they've got a 5% equity position, then you have to pay them 5% of whatever the sale is, or the market value. Okay, so on a new home construction, you're looking at 10% if you take the whole 10%.
Right,
so
right.
That's the other part to look at is when you're, for instance, on that, a $400,000 home that you buy today would be a $40,000 incentive that they'd give you. At the end of the 25 years, if you don't pay this back, all of a sudden that's a heck of a retirement bill that you just received, because now that home that you bought 25 years, if we would look at the numbers, what homes were worth 25 years past, that $400,000 home, to be conservative, would say be worth $1 million?
Yeah, at least.
Okay. So now you're looking at 10% of $1 million. There's a $100,000 bill that you received when you thought your mortgage is paid off. Okay, that you've got to now either take out equity of your home to pay back, or you've hopefully saved that up for the 25 years. But I don't know who would really have a savings plan to save that up.
Right.
So that's the hard part. Is this could sneak up on people. Okay.
So that's a good point. So that's all. I mean, that's when life is good, markets have gone up, and your price of the home has gone up.
Right.
But now if you look at it on the other side, if we're in a downturn, say 4, 5, 10 years after you've purchased a home, and you're in a negative equity position where the home is actually worth less than what you owe on the mortgage.
Right.
So not only do you have to
Cover
pay
the
the
shortfall.
difference for the shortfall of the mortgage, but you also
Have to pay this back.
pay that back as well. So it's an investment. What's happening is the Canadian government is investing in with you and sharing in the risk, but sharing in the profits as well.
Right. So that's what we've got to really watch is, especially in that downturn, for instance, what some people have been through in the last 10, 15 years here in Alberta especially, when you're in that negative equity position, it becomes very, and of course your equity will always come out first.
Right.
That's what you lose first, and because you have to pay them back.
That's
because
right.
it will be registered on your title.
Mm-hmm.
Okay, so it's
important to note.
Okay, so it's not something that will, it doesn't get reported on the credit report, so that's one point of it, but it does get put on title. So especially with the realtor side of things, is going to be watching a lot of titles, especially to find that out, because they don't want to sell this home on somebody and then all of a sudden they've got a $25,000 other bill that wasn't expected.
Right.
The other thing that we're looking for in our industry right now is how does that work if you needed to do a second mortgage? Because realistically, Bank of Canada would be in second position.
Mm-hmm.
So now when you're looking
So
at
now you're at third
now
position.
you're looking at some private lenders maybe not wanting to go into this because and it's not going to be right away because you're not going to have the equity normally right away.
Right.
The other point with this program is you have to have still CMHC insurance on it. So you can't put 20% down and still get the 5% from the government. So you could put 14.99% down on a existing home, get the 5% from the government, and you're at a 19.99% down payment. Still qualifies for CMHC because they still need to have CMHC or Genworth Insurance or Canada Guarantee, the three insurers. They need insurance on the program. Okay, so that's the other part. We can't circumvent CMHC fees altogether. We still need to have them involved.
Perfect. Okay, so that kind of answers a lot of questions about this new program that just went into effect September 2nd.
A couple of days ago, yeah.
And so one other thing that you actually made a quick note on is the ability to use the RSP program. So maybe if you could mention who qualifies for that program and how much of the RSPs are they allowed to use, and can that program be used in conjunction with this incentive program?
And it can. They are watching. They're mirroring both qualifications.
Oh.
Okay, so if you qualify one, you qualify for the other, and you can use them conjunctively. So let's give us an example. Actually, before we go into the example, maybe give us the parameters as to how much of the RSPs you're allowed to use and who qualifies for it. So the government just changed it where we can do $35,000 a person.
Per person.
Per person.
So if a married couple, the husband can, if they have
not owned a home in the last 4 years. Okay, that's the kind of the parameters in the
Okay.
last 4 years. Then the husband and wife could take out up to $70,000 out of their RSPs.
Wow.
Okay, which is phenomenal.
And they wouldn't have a penalty to pay.
They don't have a penalty to take it out. There's no taxes that get taken off on that.
That's huge.
You do have to pay back 1/15 of it every year because you have to pay back the program. You have to pay back your RSPs over the next 15 years.
15 years, I see.
Okay. So you can pay all the rate once if you want, but minimum is the 1/15 every year.
Okay.
So different than the incentive program because they're not asking for a repayment.
Until 25 years.
Until up to the 25 years, or you sell the house.
I'm glad you mentioned that. Sorry, I didn't mean to interrupt you, but that's a good point of discussion in differentiating the two programs, because the RSP program, you're free to pay back at any time but a minimum of 1/15. However, the incentive program that Bank of Canada just announced, there are some differences.
Right, so
maybe you can go into that as how they repay it.
Right, so you can repay it anytime as well, because but it has to be lump sum. You have to pay in full. You can't pay in.
That's the difference.
That's the difference, right?
So you can't just pay whenever you have extra money.
Right, you have to pay it in full. So you're having your own separate savings account and then pay it off. Or, like you said, if the equity is there when the sale comes, or you're refinancing the home years later, but that's something to consider. is that when I'm looking to refinance and I'm hoping to get $50,000 out of my home, but yet the government's going to take $25,000,
Right.
whatever that you have to pay back. So it's always something that even for us as mortgage brokers are going to have to be very cognizant of when we're talking to our customers is, were you part of this program? So we know when we're finding out numbers. Okay.
So there you have it, guys. We don't want to draw this out for too long. We wanted to give you a quick update to let you know that there are some new programs, there are some new incentives that Bank of Canada just announced. But there are limitations and there are pros and cons about both. So if you guys have any questions on this program or the market in general, please do feel free to contact me direct on my cell at 780-222-8222. Of course, you can reach me by email, rob@rjhomes.ca, and
for my cell direct is 780-887-6847, and email would be Andre, ANDRE, @Houle, HOULE, mortgages with an S.com.
Perfect. Thanks very much, Andre. I hope you guys enjoyed this information. Please do share this video with your friends, your coworkers, your family, and help us spread the word about all these new mortgage incentive programs, mortgage changes that are coming to the marketplace. Have a wonderful day.